Futures pointing to a mixed opening after the Nasdaq closed at an all-time high yesterday. Joining us right now to talk more about that is Stephen Rees. He is J.P. Morgan Private Bank Investment Specialist. Stephen, it's good to see you. Thanks so much for joining us.
Great to see you.
Here we are, just a week and a half, 2 weeks away from the first half of the year being over. What are your expectations for the second half?
Yeah, I think the second half is going to be good, but probably more like we saw in the first half, meaning a lot of volatility. We're kind of in an interesting time now where there's not a lot of news out there. We're going to hear from corporates again starting in mid-July. I think the news will be positive, but right now all the focus is on trade and what's happening with the tariffs.
And are you worried that that cuts into economic growth? I think policies?
It's tough to know at this point the actual impact that we'll have on the economy. It will have an impact. We're looking at the impact on earnings. I think what it's going to do is impact the confidence of investors and how much they're willing to pay to be invested in the market when we just don't know. So I think time will tell. But we do think it's going to be the greatest source of volatility in the coming weeks.
Right, it's the uncertainty point, which is something Dagan's been mentioning for weeks and weeks. When you don't have certainty in terms of what's happening with your business, what policies are going to impact your business, you sit on cash.
Yeah, a lot of people are doing that. We're trying to get them to focus on the longer term. We were talking earlier, everything else looks great. Corporate profits look great, 20 to 25% growth in earnings this year. Employment looks good. The economy looks good. And even valuations, we are near an all-time high, but looking at on a forward basis, 16 times PE for the S&P 500 is just not expensive. So we're advising clients to stay invested, prepare for more volatility in coming weeks and months, try to add some protection to the portfolios, and be ready to buy the dips like we saw in February, March.
You said you're buying into the pullback, correct? Even in those that are being touted as trade war stocks, you're buying?
Less on the actual stocks that will be impacted, but more on the sectors that have long-term growth stories. So think about healthcare, great demographic and drug innovation happening there. I think banks are really interesting. Not a lot of impact from the trade wars, as you've got a lot of exposure to the U.S., and we have the CCAR stress test coming next week. And then technology probably will be impacted by trade, but ultimately there's just such a great growth story there with electric vehicles, autonomous driving that I think offsets the short-term risk.
Another part of the tech story, and I know you like these stocks a lot, is huge investments in creating content, mainly video. You used to have Hollywood studios doing this, and now it's Facebook, Amazon, Apple, Google, all putting big money in there. Obviously, this is great for content creators. Even Peter Fonda can probably get some work now, but I'm wondering, as you look at this, is there a danger of kind of overbuilding? Is there a limit to how much video we're going to watch?
I think there is a limit to how much video we watch, and so you want to stick with the content creators that have a real differentiated offering and have expertise and a proven track record of creating content that people want. So you're right, there's a lot of people out there trying to do it. Ultimately, you want to stick with the companies that know what they're doing and that are getting a return, because creating content is expensive, right? There's a lot of investment that goes behind it, and you want to make sure you're getting a return on that investment.
The banner just was talking about the tech stocks at all-time highs, Amazon, Google, Facebook, and Netflix. Fred Hickey, the famous tech analyst, posted on Twitter yesterday that at the height of the dot-com boom in 2000, or the bubble then, the market cap of the 5 highest value tech companies was slightly over $2 trillion. Today, if you look at Apple, Amazon, Google, Microsoft, and Facebook, it comes to nearly 2 times that amount, almost $4 trillion. Is that an indication of the overvaluation in these stocks?
Well, the overall tech valuation doesn't look expensive, and a lot of the companies you mentioned don't look expensive. But for us, tech is much more than the FANGs. We made a decisive shift this year away from the FANGs towards some of the smaller areas, whether it's artificial intelligence, cloud computing, mobility, electric vehicles, autonomous driving.
Or chips?
Chips as well. Even some of the enterprise companies. And we've got managers that we work with that are up 20% year to date, outperforming tech by a lot. So for us, the FANGs are important. You should own several of them, but you need to think about tech in a much more diversified way.
You know, James, we did a survey at one of the corporations. I don't think we are saturated with content. What's going to happen is a reduction in productivity. When we measured keystrokes, we found the equivalent of like 300-400 full-time equivalent hours being spent online while they're at their desk looking at content, shopping, and whatever. So I think we have to be careful that content will start to drive negative productivity.
It's the way people consume it, right? People aren't watching TV. They're consuming it on the go on their phones.
Do you worry about a slowing economy in the next couple of years? I mean, there definitely is a narrative going on that we're worried about the consumer, that as the Fed raises rates, things slow down, potentially even a recession post-2020?
Yeah, we're not worried this year or next. Don't forget, you had a huge corporate tax cut. You've got a consumer tax cut.
And there's a runway for that.
You've got companies doing well. And so I think this year or next, we're fine. Beyond that, I think it becomes less clear. And we are starting to prepare clients to think about that and add some strategies in the portfolio on a longer-term basis that will actually benefit if we do get the recession in 2021.
International, where are you, U.S. versus international?
Yeah, we started the year with a balanced outlook, I'd say, because of what's happened year to date in Europe, the political situation, and at the same time, U.S. surprising to the upside from a growth perspective and earnings. Our view has shifted more towards U.S. So it's our largest overweight. It's where we have the most confidence. And I think, as we see the volatility, it's the first market we want to buy in the pullback.
You're not alone. The Russell 2000 index hitting an all-time high earlier this week. Stephen, it's good to see you.
Great to see you.
Thank you so much for joining us.
Thanks for having me.
Stephen Rees, JP Morgan Private Bank.